Okay, today we're going to take a look at Chapter 8, which focuses on accounting for long-term assets. A few accounts I'd like to point out to you. An asset account increases with a debit, decreases with a credit. Accumulated depreciation is a contra asset, increases with a credit, decreases with a debit. And depreciation expense is an expense, increases with a debit, decreases with a credit. Plant assets are tangible assets used in a company's operations that have a useful life of more than one accounting period. Names that you might see them called: plant and equipment, property, plant, and equipment, or fixed assets. The main accounting issues with plant assets that we need to focus on: first one is acquisition. We need to compute the cost. The second one is use, where we allocate the costs over the periods benefited. Scooting this up. The third is use, accounting for any additional expenditures. And the fourth one is disposal. Now let's focus on cost determination. Plant assets are going to be recorded at cost when they are acquired. The cost will include all expenditures necessary to get the asset in place and ready to use. We're going to look at an example down below. Compute the recorded cost of a new machine given the following payments related to its purchase. The gross purchase price is $700,000. Sales tax is $49,000. There's a purchase discount taken of $21,000. Freight costs terms FOB shipping point $3,500. Normal assembly costs $3,000. The cost of a necessary machine platform $2,500, and the cost of parts used in maintaining the machine is $2,400. We won't be including that cost in the regular maintenance. Everything else has to do with getting the asset in place and ready to use. So we'll be adding $700,000 plus $49,000 minus that discount of $21,000 plus $3,500 plus $3,000 plus $2,500. This is going to come out to $737,000. That's what we would record for the asset in our books. Now, the total cost of combined purchases like land, building, and equipment might also be something that we would see come into account. We would allocate this based on their relative market value using percentages. We're going to look at an example down below. So Olive Garden purchases land, building, and equipment together for $900,000. We need to record the land, building, and equipment in two separate accounts. So how much should we record in the separate accounts for the land, building, and equipment? First, we're going to find the estimated fair value of each. The land is at $200,000, the building $700,000, and the equipment $100,000 for a total of $1 million. So what we're going to do is we're going to take those estimated fair values and put them in here. The land at $200,000, the building at $700,000, the equipment at $100,000. Total $1 million. Then we're going to determine a percent for each of these of that total. So for example, land is 20%, $200,000 of the million, the building is 70%, and the equipment is 10%. We're going to multiply that times the basket purchase of $900,000. To determine how much we're actually going to record in the books. So 20% of 900,000 is 180,000. 70% will be 630,000, and 10% will be 90,000. In total, that'll be 900,000. Next up, we're going to take a look at depreciation. Depreciation is the process of allocating that cost of the plant asset to expense over the accounting periods benefiting from the use. Factors that we need for computing depreciation will include the cost, the salvage value, and the useful life. The main depreciation methods that we use in this class include straight line, units of production, and declining balance. For straight line depreciation, the calculation that we're going to use is going to be cost minus salvage value divided by useful life and periods. This numerator could also be called the depreciable cost. Down below here, we have an example of a straight line depreciation schedule. You'll notice the depreciation expense is the same each year. In units of production depreciation, the depreciation per unit is determined by taking cost minus salvage value and dividing it by total units of production. The depreciation expense is then the depreciation per unit times the number of units produced in the period. We have an example of a units of depreciation schedule down below. In this particular example, the depreciation per unit is 25 cents. We would multiply it times the number of units in that year to get the depreciation expense. On all of these, at the end of the period, the book value will be updated based on the original book value minus any accumulated depreciation. Down below that, we have double declining depreciation. In terms of declining balance depreciation overall, it's always a multiple of the straight line rate. So when we are determining this, there are a few steps. The first one is going to be determine the straight line rate. That would be 100% divided by useful life. Next up, in double declining balance rate, we would take 2 times that straight line rate. And then in step 3, we would take that rate times the beginning of the period book balance. And scooting this down. Down here, I'm going to focus that again a little bit. We have an example of a double declining balance depreciation. The depreciation rate is 40%. That was double whatever it was in the straight line. We take the beginning book value, we multiply it times 40%. We get a depreciation expense in the first year, and that'll be our accumulated depreciation. The book value is updated. The next year we start with that. We multiply it times the depreciation rate, and it continues on. Important factor to note in both the units of production depreciation schedule and the double declining balance method, you cannot go below the depreciable cost, so the cost minus the salvage value. Okay, we have an example where we're going to determine the depreciation for the first year on each of these. So Grace Groceries purchased store equipment for $42,000. They estimate that at the end of the 10-year service life, the equipment will be worth $2,000. During the 10-year period, the company expects to use the equipment for a total of 10,000 hours. Grace used the equipment for 1,500 hours in the first year. Calculate depreciation expense of the equipment for the first year using each of the following methods and round to the nearest dollar. We'll start with depreciation, or straight line depreciation. In this one, we're going to take the depreciable cost, which is the cost minus the salvage value. And we're going to divide it by the useful life, which is 10 years. We're going to get $4,000 per year. That's what it's going to be for the first year. In double declining balance method, we're going to take 2 and divide it by the service life. So we're going to get 0.20. Then we'll take the beginning book value of $42,000 and we'll multiply it times that depreciation rate. And we will get $8,400 first year. In units of production, we're going to determine the depreciation rate per hour. So we'll take depreciable cost, which is $42,000 minus $2,000, and we're going to divide it by the number of hours we expect to use. Then we're going to take that $4 per hour, and we're going to multiply it times the number of hours used in the first year. And we're going to get $6,000 for the first year. In terms of partial year depreciation, if a plant asset is purchased or sold during a year, depreciation is calculated for the fraction of the year the asset is owned. We can also have changes in estimates. We would use a new estimate to compute depreciation for current or future periods. A change in an accounting estimate related to revising the plant asset will only affect the current and future financial statements. We will not go back and restate prior year's statements. All right, now we're going to put together a full schedule using each of these methods. So we have a machine that costs $22,000 with a 5-year life, estimated $2,000 salvage value, and it was installed on January 1. The manager estimates that the machine will produce 1,000 units of product during its life. It actually produces the following: 200 in year 1, 400 in year 2, 300 in year 3, 80 in year 4, and 30 in year 5. The total units produced by the end of year 5 exceed the original estimate. This difference was not predicted, and the machine must not be depreciated below its estimated salvage value. Compute the depreciation for each year under straight line, units of production, and double declining balance methods. We're going to start with straight line depreciation. To determine our depreciable cost, We take the $22,000 that we purchased it for, and we subtract out $2,000 for our salvage value. We get $20,000. For our depreciation rate, we're going to take $20,000. We're going to divide it by 5 years. And we're going to get $4,000 per year. We're also going to take 1 divided by 5, and we'll get 0.20. Okay, so our beginning book value is $22,000. After year 1, our depreciable cost of $20,000, which we can multiply times 0.20, is going to come out to $4,000. Our accumulated depreciation is now $4,000, and our book value is now $18,000. This is kind of its own separate piece of information. In year 2, again, our depreciable cost is the same. We multiply it times the depreciation rate of 0.20. We still have $4,000 in depreciation expense this year. We add that to what we already have in accumulated depreciation. So now that balance on the balance sheet is $8,000. And our book value comes down $4,000, so that's now $14,000. In year 3, same thing happens over here. 20,000 times 0.2 is 4,000. Accumulated depreciation will increase by 4,000, so that's now 12,000. Book value will decrease by 4,000, so that's now 10,000. Year 4, same scenario on the left. 20,000 times 0.20 is 4,000. Accumulated depreciation grows again, 4,000, so now it's 16,000. And the book value is down to 6,000. Final year, year 5, we've got 20,000 again, times 0.20, coming out to 4,000. Accumulated depreciation is now at 20,000, which was our depreciable cost. And our book value is now 2,000, which was our salvage value. And down at the very bottom, our totals for depreciation expense will be 20,000. And then at the end of all the periods, our accumulated depreciation is 20,000 and our book value is 2,000. Next up, we'll look at declining balance, double declining balance method. To determine the depreciation rate, we take 2 divided by, how many years was it? 5 years. We'll get 0.40. All right, so book value at the beginning was 22,000. In year 1, we start with that beginning book value of 22,000. We're going to multiply it times 0.40. Our depreciation expense at the end of for year 1 is 8,800. Our accumulated depreciation is now 8,800, and our book value is now 13,200. In year 2, we're going to carry that 13,200 over here. We're going to multiply it times 0.40. We're going to get 5,280 in depreciation expense that year. Accumulated depreciation is 8,800 plus 5,280. We're now at 1,480. And our book value is now 7,920. We carry that over. Year 3, book value 7,920 to start. We multiply that times 40%. We're going to get 3,168. Accumulated depreciation is now 17,248. And the book value is now 4,752. Year 4, we carry it over, 4,752. Multiply it times 40%. We're going to get 1,901. That might be rounded to the dollar. Our accumulated depreciation is now 19,149. And our ending book value is 2,851. At this point, it's important to factor in that our total depreciation expense can only be 20,000. Our total accumulated depreciation can only be 20,000, and our ending book value can only be 2,000. We cannot go beyond the depreciable cost, okay? So in year 5, we still carry this 2,851 over here. We still say 40%, but What I teach my students in my CETA class is put does not equal, because the depreciation expense that we can use here is only $851. That's all we have left. That'll bring our accumulated depreciation to $20,000 and our ending book value to $2,000. That's as far as we can go, even though 40% of $2851 is higher than that. Scooting down to units of production, go to about there. For our depreciation per unit, we're going to take our depreciable cost, 22,000 minus 2,000. We're going to divide it by the number of units we expect to produce, which is 1,000 units. We're going to get $20 per unit. Beginning book value is 22,000. Scooting this up. Over here, I'm going to put in the number of units that were given to us on the previous page. In year 1, 200 units. Year 2, 400. Year 3, 300. Year 4, 80. Year 5, 30. Our depreciation per unit is always going to be 20 per unit. In total, we can only get to 20,000 for our depreciation expense total. Accumulated depreciation can only get to 20,000, and our ending book value can only get to 2,000, even though we're likely going to go above that because that's more than 1,000 over here. So what we're going to do, in year 1, we're going to take the 200 times 20. We're going to get 4,000. Our accumulated depreciation is now 4,000. Our ending book value is now 18,000. In year 2, we'll take 400 times 20. We're going to get 8,000. We add that to our accumulated depreciation. That's now 12,000. Our ending book value is now 10,000. In year 3, we're going to take 300 times 20. It's going to be 6,000. Our accumulated depreciation is now 18,000. Our book value is now 4,000. In year 4, we're going to take 80 times 20. We're going to get 1,600. Our accumulated depreciation is now 19,600. Our ending book value is now 2,400. This means we only have $400 more that we can expense out. So we take that 30 times 20. It's not going to equal what we're going to end up with, which is only 400. We're going to end up with 20,000 in accumulated depreciation, and 2,000 is our ending book value. Now let's talk about additional expenditures. When we talk about additional expenditures, we're talking about revenue expenditures or capital expenditures. Revenue expenditures are recorded as an expense. They're going to show up on the income statement. They don't materially increase the plant asset's life or capabilities. Capital expenditures are going to be in addition to the asset cost. They're going to show up on the balance sheet. They provide benefits for longer than the current period. We're going to look at some examples in terms of the journal entries that we would do related to if it was an expenditure related to revenue or capital expenditure. We have a company that pays $1,000 for equipment that's expected to last 4 years and has a $200 salvage value. We're going to prepare the journal entries to record the following costs related to the equipment. In the first one, during the second year of the equipment's life, $400 in cash is paid for a new component. expected to materially increase the equipment's productivity. In this scenario, we would increase the asset. We're going to debit equipment, 400. We're going to credit cash, 400. In the next part, during the third year, $250 in cash is paid for normal repairs necessary to keep the equipment in good working order. This doesn't really increase the life, it's just regular maintenance. So we're going to debit repairs expense for $250, and we're going to credit cash $250. Finally, during the fourth year, $500 is paid in repairs expected to increase the useful life of the equipment from 4 to 5 years. That's where we'll increase the asset again. We'll debit equipment. We'll credit cash. When we are recording disposal of equipment or a plant asset in general, there are 3 basic ways that this can happen. We could be discarding it, we could be selling it, or we could be exchanging it. The steps for accounting on this: first one, we'll record depreciation up to the date of disposal. Second, we'll record the removal of the disposed assets account balance. Third, we'll record any cash or other assets received or paid in disposal. And fourth, we'll record any gain or loss. Overall, if cash is greater than the book value, you're going to record a gain, which is a credit. If cash is less than book value, you're going to record a loss, which is a debit. If cash equals the book value, there's no gain or loss. We're going to look at some examples. A company owns a machine that costs $500 and has accumulated depreciation of $400. Prepare the entry to record the disposal of the machine on January 2nd in each separate situation. First up, the company disposed of the machine, receiving nothing in return. We're going to debit accumulated depreciation on the machine. Which is 400. We're also going to leave a space for our gain or loss. We're going to credit the machine, 500. And then we're going to note that we have a debit that we need to balance out. That's going to be a loss. Of 100. Next up, the company sold the machine for $80 in cash. We'll debit cash, $80. We'll debit accumulated depreciation on the machine, 400. We'll leave a space. We'll credit the machine, 500. We still need to record a loss of $20. In the third scenario, the company sold the machine for $100 in cash. Cash will be 100. Accumulated depreciation will be 400. and then the machine itself would be 500. No gain or loss here. In the fourth scenario, we sold the machine for 110 in cash. 110 in cash, accumulated depreciation of 400. Leave a space. We're going to have a gain in this one. Write the machine, 500, and credit gain on sale of 10. Turning the page. Next up, we'll take a look at natural resources. These are going to be recorded at cost, which includes all expenditures necessary to acquire the resource and prepare it for its intended use. Depletion is basically depreciation for natural resources. This is the process of allocating the cost of the natural resource to the periods when it is consumed. Natural resources are reported on the balance sheet at cost less accumulated depletion. To determine depletion per unit, you're going to take cost minus salvage value divided by total units of capacity. Depletion expense itself is depletion per unit times the units extracted and sold. Now, important thing to keep in mind, if we do not sell all of them, we will have an additional entry for inventory. And I'll show you an example of that down below. A company acquires a zinc mine at a cost of $750,000 on January 1. At the same time, it incurs additional costs of $100,000 to access the mine, which estimated to hold 200,000 tons of zinc. The estimated value of the land after the zinc is removed is $50,000. First off, we're going to prepare the journal entry to record the cost of the zinc mine. So on January 1, we're going to debit zinc mine. We're going to take the $750,000 and the additional cost of $100,000 is going to be $850,000. We'll credit cash, $850,000. Then we're going to prepare the December 31st entry. If 50,000 tons are mined and only 40,000 are sold in the first year. First, we need to determine our depletion per unit. We're going to take the $850,000 cost, subtract out the 50,000 salvage value, divided by 200,000 tons. This is going to come out to $4 per ton. On December 31st, we're going to debit depletion expense, which is going to be 40,000, which were sold, times 4, and that'll be 160,000. We're also going to debit zinc inventory for the other 10,000 that was not sold. That'll be 40,000. And we will credit accumulated depletion for 200,000. The last type of long-term asset that we see in this chapter are intangible assets. Intangible assets are non-physical. They're used in operations and give companies long-term rights or competitive advantages. Some examples might be something like a patent, a copyright, a license, franchise, goodwill, trademarks, leases, those kind of things. Lack of physical substance does not always mean an intangible asset. Notes and accounts receivable, for example, lack physical substance, but they are not intangible assets. We are going to record these at cost. This is going to include purchase price, legal fees, and filing fees. Instead of depreciation, we're going to use amortization. And we're going to look at some examples with that one. First up, a publisher purchases the copyright on a book for $1,000 on January 1 of this year. Copyright lasts 5 more years, and the company plans to sell the prints for 7 years. Prepare the entry to record the purchase of the copyright on January 1 and its annual amortization on December 31st. So January 1, we're going to debit copyright. It's an asset. 1,000. We're going to credit cash. 1,000. On December 31st, we're going to debit amortization expense. And we're going to take that 1,000 and we're going to divide it only by 5 years. I know they say they're going to sell it for 7 years, but the copyright itself only lasts 5 more years. So it's going to be 200, and the credit will be to accumulated amortization. In my next example, on January 3rd of this year, a retailer pays $9,000 to modernize its store. Improvements include lighting, partitions, and a sound system. These improvements are estimated to yield benefits for 5 years. The retailer leases its store and has 3 years remaining on its lease. Prepare the entry to record the cost of modernization and amortization at the end of the year. So first up, January 3rd, we're going to debit leasehold improvements. For $9,000, and cash is your credit. And then on December 31st, we're going to debit amortization expense. We're going to take that $9,000 and divide it only by 3 years, because that's how long they have left on their lease. And we'll credit accumulated amortization.